Hi, good afternoon, everybody. My name is Jessica Gant. I'm the CEO and Director of DCG Fund, Dynamic Communication Global. We are a company that has set up this investment fund to provide a safe and secure source of wealth to our clients who are conscious about renewable energy while aiming to offer promising returns. And this medium-term investment looks to target corporate profits of growing and established businesses that are resilient in economic downtime, so they are able to rebound quickly from adverse economic conditions. So this is our agenda for our presentation today. So introduction, already said, the purpose of funds. And we have selected 3 benchmarks for fund to either to match or outperform. So the 3 benchmarks are market, VIT, and passive investment. So market basically represents all the US companies and that are listed on the New York Stock Exchange or NASDAQ that we have value-weighted return of all these firms. VTI is the Vanguard Total Stock Market Index Fund. And the other one, Passive Investment Fund, basically has got 11 identical stocks as the DCG fund, but no rebalancing required. So DCG fund rebalances every 6 months, and we have reduced the fee to 1% per year, which I will explain later on in the slides. So portfolio construction. Now, we have picked 11 companies out of the 11 GICS sector in US economy. Now, all these 11 companies are active green partners with US Environmental Protection Agency. So when our fund started at the beginning of 2017, during the first half stage of the fund, the US economy had the longest economy expansion on record. And during the second half stage of the fund, the economic climate has seen some turmoil and volatility due to COVID-19 pandemic, which caused disruptions to global economy and uncertainties to the financial market. Due to this change, our initial dealings of our portfolio has changed. We adjusted the weightings of the portfolio at the end of 2019 to limit losses. In addition, we recognize the impact of COVID-19 to all the business sectors and decided to waive the performance fee charge and reduce the management fee to 1% per year. So as we recognize the possible 3 scenarios halfway through of our fund, so which we have equally allocated to 33%, as you can see in the middle chart here. So we readjusted the weighting of the fund at the end of 2019, beginning of 2020. So comparing with the 2 weightings of the 2 charts on the left and the right, so the Y on the right has a focusing in healthcare. There's 25% in Elevance Health and 25% in Walmart. So Walmart is the customer defensive sector. So now you're probably going to wonder, so how did DCG fund perform? So DCG funds performed well comparing with the passive investment. As you can see, the accumulated wealth when they both started from $100 million. In fact, I have the actual figure here. At the end of December 2022, the value of DCG fund before fee deduction was $246.72 million. It exceeded the passive investment by 16%. Because, as I said earlier, we recognize the impact of COVID-19 to all the business, and we decided to waive the performance fee charge and reduce the management fee to 1% per year. So after the management fee deduction, the net value of DCG portfolio became $225 million, which was only 7.2% superior to the passive investment. So here, that's why you see the two funds are going to converge. So on the most right-hand side, this is a average annual return between DCG and the benchmarks, the three benchmarks. So before fee deduction, DCG performed the best at 18.11% per annum. Now, next one, we're going to go a bit more detail and look at the each securities, the securities and of the portfolio. So first, each portfolio has a beta, which represents the sensitivity of the company to the overall economic condition. As you can see here, Tesla has got the highest beta here, 2.07. Well, some other companies, for example, like Elements Health has 0.83. So all these companies which has got less than 1 beta means they are defensive stock, they are value stocks. They are more resilient during economic downtime. So which now leads to this graph on the right-hand side. So we see here in the orange part of each chart here, each bar, that represents the trainer ratio. So the higher the trainer ratio, the better that shows the performance of each stock. So of course, Next Era Energy has the highest and followed by Elements Health because they both has low beta. Next Era Energy only has 0.46. So this is what this chart represents. And down the bottom here, sorry, went too fast. So down the bottom here, this represents each security's contribution to the overall DCG fund return. And as we can see that Elements Health has contributed the most because it's on the most outward circle here. And so is Walmart, and then it's Tesla. Now we're going to drill a bit further to look at the top 3 and bottom 3 stocks of our portfolio. So top 3 is Tesla, Apple, and Elements Health. And the bottom 3 stocks are the 3. So Ecolab, Owens Cornings, and JP Morgan Chase, representing financial services. So as you can see, the top 3 stocks, Tesla, Apple, and Elements Health, they all have outperformed each industry that they represent. However, I must point out, Tesla and Apple also showed greater volatility, especially Tesla had greater volatility comparing with the industry consumer discretionary. And Apple also has more volatility than technology. But Elements Health actually has less volatility than healthcare sector overall. And so down the bottom, you can see that the 3 stock, Ecolab, Owens Cornings, and JP Morgan Chase, they all underperformed comparing with its industry. Now we're going to look at a few performance measures so that we can assess the overall performance of DCG funds. So the first one we look at is Sharpe ratio. And I have two Sharpe ratio graphs here. The one on the left represents the average annual performance, and DCG has the best performance here because it's got the highest Sharpe ratio. And on the right-hand side is a year-on-year performance. And we can see here that DCG had a slow start and then pick it up in 2018 quite quickly, and then outperform the benchmarks. And until 2021, it started to deteriorate. And this graph actually verifies what we saw here earlier in this one, DCG overview, that in this bottom graph that it showed DCG had the strongest year in 2020 with a 47% increase, and the worst performing year in 2022 with a negative 26.59%. So these two graphs really, they correspond to each other. So let's come back to performance measure. So on the left here on the bottom, we have Sortino ratio. Now, Sortino ratio is different from Sharpe ratio because Sortino ratio only considers the downside volatility, while Sharpe ratio captures both upside volatility and downside volatility. But still, DCG did perform the best, again, as well comparing with the benchmark. On the right-hand side, we have trainer ratio again, but this time it's a trainer ratio between DCG funds comparing with the benchmark portfolios. So the higher the trainer ratio, the better. The orange part is a trainer ratio. So as you can see here, DCG has lower beta ratio, which is the blue part comparing with the benchmark. So therefore has a higher trainer ratio. So which means it had better risk-adjusted performance. Now we also look at the three-factor model and how that has explained DCG's performance, because all the investors and most concerned question is, did the fund actually generate any alpha, or the alpha is zero? So we look at two different three-factor model. The first one is the well-established Pharma French three-factor model. And the other one is the gold fixed income three-factor model. So the reason why we have a separate gold fixed income three-factor model is because in economic downtime, now gold and fixed income are considered a haven for all the investors because they provide certainty, they provide security, and that's why we set up a separate model. And so in this one here, actually, we have used the S&P Bond 500 index as a proxy for fixed income. So as we can see that both model have yielded a positive alpha, so which is a very good complement for DCG funds. And then we go down, we see the beta market premium, the first beta. So now both models yielded a high beta of the market risk factor. This suggests that the return of DCG fund is more influenced by the systematic risk. Now, this can also be verified, and by the bottom here, the bottom measure, which is the systematic component here. If you look at this figure here, this represents 75.9% of the overall risk. And so, which is actually, which means on the other side, the idiosyncratic, the firm-specific risk has been reasonably diversified, which is very good. And now look back to the beta again. The second beta, which is beta SMB, which is minus 0.2189. So what that means, it's a negative figure. This indicates that DCG return is more influenced by the performance of big capitalization stocks rather than small capitalization stocks. This actually makes sense. It's because of all the 11 stocks that we have picked for our portfolio, they are all top 10 firms in each industry with the biggest market capitalization. So the next beta is the beta HML, which is also a negative 0.3046. So what that means is DCG return is more influenced by the performance of growth stocks. So growth stocks are stocks that has got a beta that is more than 1. That is talking about this graph here. Here, let's talk about this graph here, growth stocks. So which means those ones that less than 1 are value stocks, but they obviously are less proportion here. Let's go back here. Yeah. Okay. Now on the right-hand side, with the gold fixed income model, the beta gold has got a 0.2672. Beta S&P 500 bond index is 0.1391. So the bars don't seem to be very significant, and they're relatively low and seem to indicate that DCG is not significantly influenced by gold and fixed income. Excuse me. And here we also have an information ratio on both sides. So information ratio, both have a positive high information ratio, which means DCG generates return over the market and the fund manager has achieved alpha, which you already saw. Yes, has achieved alpha. So here we go. Now we have looked at everything here, and now, so we have looked at how DCG has performed. Now, next question would be, so what is to the future now? What can we forecast about the future? Well, we believe that for the next 3 years, from 2024 to 2027, we're going to see a boom of information technology across all the sectors of the economy, because COVID-19 has completely changed how people do their shopping, how people do their work, how people go to see their doctor, everything. So there's going to be a much stronger demand for digital economy. And also we're going to see a stronger global demand for electric cars, and due to increasing environmental consciousness from consumers and increased regulations pressuring the manufacturers to develop and use electric batteries in all the vehicles. And more government and consumer expenditure on healthcare will grow as well. So again, all the 3 events we believe will have an equal likelihood of happening. So we also recognize that there will be 6 sectors that actually this one, 6 sectors that's here, 6 sectors that 6 industry will contribute to the booming of the global economy. And these 6 sectors are consumer defensive, healthcare, technology, communication service, consumer discretionary, and financial services. Now, as you can see, this biggest portion, 34%, that is the technology. And then followed by communication service, that's artificial intelligence. And with all the other four sectors are equal. So with this in mind, then we have carefully selected 7 stocks here representing 6 companies because 2 of them are of the technology sector. So as you can see here, with these 7 companies on the left-hand side, their symbols, their tickers. So none of them has a beta over than 2 because we want to keep it below 2 so that they can be more resilient and in economic downtime. And so, and the 7 companies out of the 7, 4 of them are from the existing DCG fund, and some of them very top performing funds, such as 11th Health. And the other 3 are international companies like ASML and NVDA. They're both technology companies. And Lee ASML is based in Netherlands, and Lee is in China. It's electric car manufacturer. So this is the new portfolio that we will propose for future investment outlook. And we also adopted a stochastic process to work out, to forecast the returns of the next 3 years. And for DCG funds, actually for each of the 7 stock, and then DCG funds, and also the risk-free rate, the market return, the VTI. So we are keeping the same benchmark. Well, except we added the risk-free rate here as well. We forecasted everything. And so we used the optimization again, and this is the weighting that of each asset that we think will help maximize return and maximize the Sharpe ratio. And this is the Sharpe ratio here. So the market has a very huge return, just shows the market is going to be very volatile again. And then followed by the DCG 57, and the passive investment is just 50%. So this is our forecast for the future. So overall, what's our recommendation for our fund performance so far? Well, our decisions actually to refund our client net of the fee deduction. The reason is because the DCG fund was only able to outperform all the benchmarks because halfway through that we adjusted the management fee. So has that not been changed, then it would not be able to outperform the passive fund, passive investment. And that 1% per year management fee is actually not sustainable in the long run. So that's why we think investors will receive better return with passive investment on market index such as SP 500. And this is our recommendation. And thank you so much for your time. And we're looking forward to hear your feedback.